Welcome back. Danielle, I want to use this block to discuss how investors even begin to evaluate ETFs because there's close to something like 1,000 funds to choose from, right? 40 fund sponsors. And the feedback I get is that it can feel very, very overwhelming. People don't know what to pick, and then it leads to this analysis paralysis. So maybe we can start by you explaining or reminding people what differentiates ETFs from mutual funds?
Sure. So an ETF and a mutual fund, the similarities there are they are funds that hold a basket of equities or bonds. Now, the main difference between the two is that an ETF trades on the stock exchange. So it trades like a stock intraday on the exchange when market hours are open. A mutual fund is purchased, the price is marked at its end of day net asset value, which is marked at the end of the day. And usually there's accountants and there's a team of people pricing all the holdings in that mutual fund to give it its end of day NAV. Now, an ETF, because it trades intraday, it has a market price, which a mutual fund won't have. And that market price can move throughout the day, and it reflects the underlying holdings, how they're moving in the market. So with that, there is a bid-ask spread that's involved with an ETF. It's usually quite small, like 0.03% or 0.04%. But that's also a trading cost involved with purchasing an ETF. But that bid-ask spread really tells you how liquid the ETF is, which is a big benefit for ETFs, that liquidity.
Yeah, and Danielle, I think one of the important things as well is if you're outside at least tax shelter, like your TFSA and RSP, one of the things with ETFs is you can control the timing of when you're going to get hit with taxes as well, right? Because it does trade like a stock. So you decide when you're going to sell. Is that right?
That's correct. So you can sell a mutual fund or an ETF in the same day. Yeah. It's just the price of that ETF is marked throughout the day with that market price that does shift around. Whereas the mutual fund has that net asset value. It's determined at the end of the day after market closes.
Okay. One of the things that I have seen is that a lot of mutual funds have been getting more into the passive side of trading, and ETFs are getting more to the active side of trading, right? They're not necessarily all like employing a passive strategy. Can you walk us through that, the active versus passive, and what makes sense? What should someone look at?
Sure. So historically, in the mutual fund world, what you would have is you'd have a fund manager who would use his or her expertise, and they would have a team of analysts, and they would use a strategy to pick what they think are the best equities or the best bonds within a specific fund. And the goal would be to outperform the broad market. We say this is providing alpha. Now, what ETFs got really popular for were they were providing index-like returns. So this is returns just like the broad market. So you can own an S&P 500 ETF and you get the exact returns of the 500 largest stocks in the US. Whereas an active manager might want to try to pick 50 of those best stocks and try to beat out the passive. So what we're seeing is actually investors using both and using them both in portfolios, sometimes an indexed approach for more of a core part of the portfolio, and then adding tactical satellite positions that are active strategies around that core to kind of tilt the portfolio, provide a little more alpha. But we are seeing both ETFs and mutual funds now both interchangeably using passive and active strategies. And it's really all about the vehicle of choice for the investor. What do they prefer to use? Would they rather the mutual fund or would they rather the ETF?
Yeah, yeah. And there's so much focus on fees, isn't it? And we know that fees are important because it does erode your returns and creates this drag on the compounding effect. But it's still really important, especially if you are using ETFs and a do-it-yourself strategy. You still have to know which ones to pick and how to create that portfolio, don't you?
Correct. Yeah. So fees are something in the ETF space, which have become very, very popular because fees are very low in ETFs. And if you think about something like a broad beta ETF, like an S&P 500 ETF or a broad market Canadian equity ETF, you're looking at fees that are as low as 0.05%, 0.08%. So very, very minimal. I think the mutual fund world got not a bad rap, but there are legacy funds who have much, much higher fees. And again, I think the ETF world has made the mutual fund world look at itself and say, should we be, pulling our fees down? Should we be a little more competitive? Because now you are finding active strategies that are a lot more competitively priced as well.